Welcome everybody to the Crest Build to Rent business plan. We're very excited to talk to you about what we have cooking. However, this presentation is not going to be about us. You see a lot of webinars where people talk about their track record and what they want to accomplish. Really, this webinar is not going to be about any of that. This is going to be a lot more based off of the person that is listening, the audience member, the character in our story. We're going to be doing this as a story and following the framework that basically takes a person that wants to accomplish something, you listener, a character that's got a problem, which in most cases, and the whole reason that a lot of you guys would even want to listen to a webinar like this is because you're looking to create either generational wealth or you have some type of time freedom issue. You'd like to be hanging out on the beach or spending time with your grandkids or just really get out of your W-2. And what we're going to be doing is presenting a solution. But the way that the story framework works typically is when an investor or a person in your case has a problem, you meet a guide, which is exactly what we are. We're not the hero of the story. You guys are actually the hero. And what we want to do is provide you with a plan and call you to action so that way you can avoid failure and end in a success. And what we're talking about is this challenge that I think a lot of us have when we want to create passive income or make an impact in the world. And how do we do it in such a way so that it makes sense for ourselves, our family, and how can we make an impact? Well, we're going to be presenting a solution to this. And then hopefully at the end of the day, we'll be able to provide you with something that can create a great deal of generational wealth where somebody comes in with for example, just throwing out some numbers, $100,000 investments. And then at the end of this particular project, we more than double that within just a few years and take $100,000 investment and return that to you and bring you back $212,000 is the projection here. So with this, I'm going to get started just with a little bit of our background so you know who you're working with. We have Andy McMullen on the webinar, one of my great friends, a really great guy, has been around for over 20 years, has cycled through multiple deals as a lead sponsor, has transacted, get this, over approximately $750 million worth of real estate, which is a big, big deal. We got Derek Alexandrenko. I went and visited him recently, probably about a month ago in Lafayette and toured our property. He's been a developer in over 50 projects and has been doing this for 15 years and has really figured out this particular model that we're going to be talking about, build to rent, and how it ties into, in a very similar fashion, being a multifamily investment, but different and better than your typical value add project. And he's done all of this while also getting an MBA at LSU. His partner, one of our operating partners, Chris Ventra, has been an acquisition specialist for 15 years, has identified 2,500 plus projects, has been amazing, and has actually worked on projects with capital expenditure amounts ranging from 5 million to 7 billion in the United States. So this is going to be a lot of fun, and let's go ahead and get into it. With this, I'm going to turn it over to Andy, my friend, my brother from another mother. Tell us a little bit. Welcome to the webinar, man. Tell us a little bit about build to rent and, expose us to it. Tell us a little bit about what it is.
Yeah, when I get that question, build to rent, some people like to think of it as single family, but it's really not single family. It's think of it horizontal multifamily. So you basically took a multifamily project and you just pulled it apart, right? So we've got, houses with their own yards, their own ceilings, their own space in between each houses, but you manage this entire community, this entire enclosed community as one, in the same way that you would manage a multifamily project. So that's in its simplest form. Think of it horizontal multifamily.
Okay, cool. So tell us more about exactly what is build to rent.
Well, I mean, I think that what people experienced maybe even in 2012 when the economy started to come back, that there was all this kind of Wall Street money coming in. And basically there's these scattered houses that were managed by, 100 units in 4 different counties. And then a genius figured out, hey, why don't we just build them right next to each other and manage them like one community where we've got all the efficiencies of scale. So you can kind of see, we've got about 16 and a half million single family rentals, but a lot of those are scattered, right? Very few of those are right next to each other. So we're kind of in the early innings of this thing. I would say that in general, rent growth for multifamily has been pretty consistent, pretty recession resistant, right? Even in the last cycle, I think it never dipped below maybe 90%. And what I think is also interesting about this class is that you're basically getting renters from both sides. You're getting the young millennial renters, right, that maybe by necessity need to rent, but you're also getting some of means renters that basically love the new American dream of traveling, right, and new stuff. They want new technology. They want their own backyards. And in addition, we've seen a lot of kind of empty nesters or boomers, that have been living in their house for years and still want to have that yard, but they don't want to cut the grass. So I think all of those kind of conjoin into this huge trend, which has kind of become the tsunami in the Wall Street world.
So why do you think that this tsunami is happening?
Well, I think the big reason, if there's just a single reason, is that these guys, and when I say these guys, I'm referring to institutionals, banks, investment banks, they're all looking for yield, right? And the bond returns are so low for them that that's a hard market to be in. As stock market's very expensive, very unpredictable. So if they can kind of let the little guys, the little developers like Derek and myself build these projects, then they can chase yield with efficiencies of lower expenses, because these are all new and the expenses are relatively low, and efficiencies. They can manage these projects a lot more efficiently, and then they can push up rents with growth. And that's kind of how they catch both sides of it. The idea that rents are increasing and values of these assets are increasing. So that's why it's been so, you've seen Lennar, for example, who's been historically a home builder. Now they basically are building homes just for rent. They believe in this trend so much. You've seen D.R. Horton. They did a deal from a project down the street from one of our other projects where they got in probably all in about 14 million and stabilized the asset and sold it for 31. So they can make some big dollars, and they can do it relatively safely based on the fact that there is so little supply out there. So that's just a little bit about why it's such a big deal in that institutional world.
Yeah, it seems like it's a great opportunity for certain investors. Who exactly is the ideal person that can benefit from investing in this type of project?
I don't think it's for everybody. I mean, we're talking about this is not like a small 6% cash on cash deal. This is going to be a high expectation of we're getting our investors' capital back in 3 years, right? 3 to 5 years. We really, especially Derek and we really focus on how we can kind of bless these communities. This slide is a little bit about the areas that we kind of like, and we'll kind of come back to exactly who this is for. But let me just talk a little bit about this movement, because this kind of calls to our process. In the Southeast especially, there's a huge upside opportunity, and part of that is because we can get the land in our acquisitions. We talked earlier about Chris Boncher. He spends hours and hours trying to figure out what are those target areas where we can, one, buy the land inexpensive enough, two, that's the lowest impact fees, water, sewer, all the rest of it. 3, that's in an area where it's landlord friendly and developer friendly, because that's a huge deal, right? When you need to get things pushed through. And not only that, it's got to be next to good schools and some amenities, right? And close to a thoroughfare. So the area that benefits the most is this kind of target Southeast market, and specifically for us, Lafayette, Louisiana.
Cool. Speaking of Lafayette, man, I was just there about a month ago. I'd mentioned previously, I went and hung out with Derek and his beautiful family. They were great hosts to me. And kind of I want to turn it over to him because he's just been amazing. I've seen his track record, what he's done. He's taken me to some of the amazing houses that he's done. He's really got a grip on what it is that the ideal resident experience should be, and uses this concept to build out his individual units and houses that he's been doing. With this, I'm kind of curious, man, if we could touch up on your previous history of building properties, and so we could explain to the investor here what it is that makes you a special individual when it comes to building, and your focus on the resident, and what kind of stuff you've created in the past and how that's evolved over time.
Sure. I mean, I've started out remodeling houses, and I was also in charge of leasing those out. Every property I've had, I would remodel them, and then I'd lease them out afterwards. So I would get that feedback from every tenant on what they liked about the unit or what they didn't like. And with that feedback, I was able to do it again. I've really learned what works well, what gets the best response, and what items that I'm putting in there get the most bang for my buck. And as it evolved from doing remodels to doing new construction, which once I started doing new construction, I pretty much quit doing the remodels because I could get exactly what I wanted from the start. I could design it, draw up the floor plan, and I could not only engineer it to be the most economical construction as far as lumber sizes, laminated timber, all kind of stuff that as a general contractor, you can try to steer the engineering of the building to control costs, but also the finishes, and that changes and evolves with time. So it's kind of continuing to get that feedback, as trends change, but also trying not to be too trendy to where stuff, 5 years from now is not, going to be what they want anymore. You try to stay neutral, but also put these things in there that really get the wow factor, and stuff like that will get that wow factor year after year. Like the vaulted ceilings is something easy that we could do, but it makes these small, efficient units, these cottages, really feel much larger than what they are. So these people, they don't think that they're in a small rental unit. They can really feel like it's their own home.
Yeah. Tell me a little bit more about this particular Crest project. Where exactly is it? How are you building the units? What are you trying to put into each one of the properties?
It's in Lafayette, Louisiana. It's off of one of the major thoroughfares in town here, where we have the Sam's and Walmart. It's less than 5 minutes drive to Walmart. So all of the amenities are close by: the Costco, the Lowe's and Home Depot, Best Buy. So, but we're a little bit further out. So we were able to we're in the edge of that growth, which allowed us to get the track. I purchased it a couple of years back and started building on myself. I got it at a reasonable price to where I could afford to put, these units and get a lower rent and really rent them out easily, and kind of test it before I even started to build out the model on this. And, since that time, it's just, with lumber prices and COVID and everything that's happened, the rents have gone through the roof.
Yeah.
And I've gotten to reap the benefits of that, but it was really testing out, these units on this particular track before deciding to do even more units there.
Yeah. So I'm very curious, because you're building a bunch of individual properties. And this was kind of my biggest objection when I first learned about build to rent. I'm like, people won't understand it. People have lived in a multifamily apartment. They can kind of understand the business model. However, this is a very similar and actually more powerful model than a regular value add multifamily, in the sense that we are actually taking a bunch of individual cottages and running them very similar to a multifamily. Can you expound upon how this particular model of doing business is like multifamily, but much more powerful?
Really, the upside of this model is one, we're getting a differentiated product from all the other multifamily that is out there. You're not having to go up 2 or 3 flights of stairs. You're not having the neighbor's kids running around in the middle of the night, waking you up, or the dogs barking. Because each house is detached, it limits those types of things that you normally have people choosing not to rent a multifamily or having to move out. So these are a lot stickier for the tenants. They tend to stay a lot longer once they move in, because they have that personal space and they don't really have the same reasons to move out. And like Andy had said, we're capturing folks that are either moving up and need more space than you would get in normal multifamily. They want to have their own yard, they're having their first baby, or they want to work and have their home office. And then we're also getting the folks that are downsizing. but not ready to go into a senior living or anything like that. So we're capturing both sides, but really we have the great things about multifamily still apply here. The appreciation, the forced appreciation, the same principle works with the because we have multiple doors. We get the economies of scale from managing it like a multifamily, but we also have some extra protections in place. If things didn't work out, we could always pivot, and we have the option of putting together HOA and selling these off individually.
Yeah, it's very interesting when you're considering putting your money into a multifamily where there's a unit on top of a unit on top of a unit. Whereas with this, you're really providing a greater interest level for a potential resident because they have their own driveway, they have their own complete privacy, and like all of the little amenities. I believe there's going to be a dog park and a playground, so it's going to be a community, not just of units built on top of units, but an entire neighborhood that we're going to be renting out. And we've already exceeded our projections on the rental income. But one thing that kind of struck me here is that in Lafayette, there's a lot more there than just what I saw. So Andy, I'll kind of turn it back over to you. I'm very curious if you can kind of go over the neighboring areas, what's going on. Is there any projects that are similar to the one that we're building out, and what have you seen in that regard?
Yeah, what's interesting is so if we're in that kind of top left corner, you're 2 minutes, really 2 miles from, the Walmarts, the Sam's, maybe 2 to 4 minutes. PetSmart, you got all the amenities along there. There's the mall kind of in between there, but you can kind of see all of the other projects that are going on. And there's multiple development projects because they see the growth and the opportunity in this area. I will say anytime you get a Whole Foods, Starbucks in the area, they spend a lot of attention to where they want to be. But I think the most fascinating part of this particular map is the project there, the cottage at East Broussard. Now that project is about, I want to say 100 some odd units, but it's a horizontal multifamily built to rent project. It's currently in escrow. I haven't got the number, but I do know that it had multiple offers. This same owner has other projects in Lake Charles, which is a neighboring area. I think it's also telling if you look at the rents. Now, when we underwrote this thing, we were looking at rents that were maybe in the $1,550 range, $1,475 on some of the first units that we ever rented. I believe we rented our last unit at about 16 and a quarter, right, Derek? And I think that was with, maybe that included pet rent or not, but the trajectory is right. It's upward.
Cool. I'm going to bring it back to you, Derek. I'm very curious about the construction side of things. Let's actually take a look here at the floor plan. Can you tell us about the entire process, what it is that makes our team very reliable at doing this, from the ground up, the entitlements, the finding of the actual plots of land, and all the crews that come in, and how you've been able to put all of those people together, including some family members of yours, to help put these entire processes in place?
It's really an assembly line process, whether it's the entitlement process before we even get started with construction. And Chris helps me with that. He specializes in that. He's done all types of, industrial and commercial and residential subdivisions. And he's a landscape architect, so he could help us design the streetscapes and everything, and work through that process with the local government to get the entitlements, which is in general on a development project, the toughest part. And then once we actually break ground, that's whenever, I really come into my own and what I handle. And I do have a couple brothers, and my dad, he's retired, but he plays on the tractor and does some stuff around on our projects. So it helps to have people that you trust in certain positions, but we've worked with a lot of our subcontractors for years. And when you're doing this type of thing over and over, it's good to have a certain size subcontractor that can handle doing that many HVAC units or doing that many slabs in the course of a week to where they could keep up and they can handle the assembly line, the process that we have, because if one domino doesn't fall when it needs to, it could have an effect all the way down the line. So that really comes into, again, working with the same once you find a good subcontractor, you keep them and you plug them in, and they, it's just rinse and repeat with these guys.
Exactly. One of the keys to mastery is to repeat the process over and over and over and over again until you do become very proficient at it, which is something that you've been up to for quite some time. But let me ask you this. Let's see if we can throw an objection here. Aren't the construction costs going up in Lafayette and across the country? Tell me about that.
Yeah, they did spike last year up to a little under 1,700, but they've come down over $1,000. So it's stabilized. It's still a couple hundred higher than it was traditionally, and I think that's kind of going to be the new range, until we get well past this pandemic. So probably I'd say for the next year or so, we're still going to stay in that range. But it actually, I think, for this project has benefited us, because whenever that was happening, we were in the middle of our underwriting. And we put in a huge contingency reserve. We're not sure, where we're going to be going with lumber prices. So we stuck in a huge contingency above what we think we need. And it also, I think, fed into the escalation we've seen on the rent side. We all know real estate is in general an inflation hedge, and that's been true enough. What happened was builders couldn't build houses anymore for the same price. All the prices of houses that were for sale to homeowners went up, and that forced more people to rent, and rent started going up. So we saw that. That's why our rents now are $100, $125 more than what we had in our underwriting.
Yeah, and going up fast. Can you tell us a little bit about the safety of this particular part of the state of Louisiana? Is it far away from the coast? Do hurricanes cause any damage? Is there floods? What kind of stuff happens here? What have you seen over the last, let's say, decade in terms of what kind of problems have come up or no problems come up from your experience?
Sure. Yeah. I mean, every year we have hurricanes coming through. Last year it was Lake Charles. This year it was over towards New Orleans. So it is something we deal with every year, that we get slapped around a little bit. But I've lived here my whole life, almost 40 years, and I've never had to file an insurance claim for hurricane damage. The worst I've seen is a couple of fences get laid down, or we lose power for a day or two. That's generally what most people are scared of, is losing everything that's in their freezer, because their power is out for 2 or 3 days and you have no control over when it comes back on. But in general, we are about 30 or 40 minutes from the coastline. So we have all that swamp that makes Louisiana famous between us and the coast. You always see on the Weather Channel, the coast just getting slammed, and those coastal communities can have catastrophic damage. But in general, by the time it gets here, you'll have some shingles flying off, tree branches, or a couple trees laying over, or things of that nature. But it's pretty much hit or miss. Now, if it's a catastrophic storm does happen, like with New Orleans, that was a lot of flooding because of the levees. So that's kind of a different situation whenever that happened. But Louisiana in general is low lying, so the flood is the other question you had, and they do have floodways and flood zones. This property is not in a flood zone, so we aren't required to have flood insurance. Whenever you build in flood zone areas, they make you go up to a certain elevation. They require you to get that insurance. This particular property doesn't have that, and we still put in a retention pond that's designed to handle a certain type of storm. They call it like a 50-year storm or 100-year storm, and it has to be designed to handle that kind of water retention. So anytime you build now, they make you put in the type of system that could handle that extra water. Whereas 20 or 30 years ago, we would just build what we want. And that led to a lot of these problems that we deal with now with, flash flooding, kind of, because the water didn't have anywhere to go.
Yeah, so I didn't see any major specific catastrophic events that were going to be red flags for this particular area. But in addition, because of the heavy rains at times and winds, you guys build these little cottages like tanks. Is this correct? Tell me a little bit about what makes them so weatherproof.
Well, first, it's just the actual design. They're compact, so you don't have any extremely long walls. And you can see we have the middle wall going straight down the spine of the building, if you will. So that adds to extra strength. The entire building is wrapped with OSB. So the shear strength, as far as the wind and buckling and stuff, is extremely sound. In addition to that, they have architectural 30-year shingles. It's a higher grade shingle designed for higher wind events. And then the siding, it's a cement board siding product. Yeah. It's not vinyl siding.
Fantastic. Okay, so Andy, let's talk a little bit about the deal. How about you tell me more about the breakdown? Exactly what is somebody going to get if they invest in this, and how is it going to help them?
First, I gotta say, man, how much fun I have geeking out on when Derek geeks out on the construction stuff. Because I know a lot of people love that stuff. I'm one of them. Some people are like it's eye rolling, but I love it. It's kind of cool to see like how you start from just nothing and master builder creates this master building. So here's the deal. It's a $11 million loan. Investor equity will be raising about 2.5 million. As I mentioned a little bit earlier, Ruben, I think we hit on it. This is not a deal for everyone. There's going to be a specific investor here who really wants the upside return. There's not a lot of space available. We're investing 2.5 million. So I mean, we're only raising 2.5 million, and we've already raised about 1 million. So without it sounding like I'm really selling, I don't want people to miss out on this opportunity. As you'll see here coming down the pike, there's a couple of reasons why. But in general, that's what our money is going to cover: the site development, the building costs, development fees, and Derek mentioned that just monster contingency reserve there. That's the deal breakdown.
When you compare it to a typical multifamily property, a value add that a lot of our competitors in the multifamily space do, what is it that makes this particular type of multifamily acquisition so much more lucrative than what they may see somewhere else? I mean, when we're talking about the investor and the generational wealth that they want to create for their own family, can you discuss really what's in it for them that they couldn't find in other places, and what makes this more of an attractive deal for them? I'm talking about big picture, like how can the investor that comes and participates in this deal have a greater impact for their families in terms of creating wealth, and in terms of also having and creating a difference for the communities that are involved with that we participate in when we do projects like this.
Yeah. So
Whereas,
Derek and I, we and you, Ruben, as well. We talk a lot about how we're serving our communities, right? We really we said it probably multiple times that we want to invest in people that are not also good at what they do, but are doing good, right? And so we spend a lot of time with partnerships in the communities. As Derek mentioned, we're building out the playgrounds. We've already scheduled our turkey days, right, to be handing out turkeys. We've got ice cream days for the kids. We really want to make sure that this community is tethered. And in past projects, we've done a lot of partnerships. We brought in Apartment Life, which is kind of, think of like an RA of a community, and there's a lot of organizations too we're talking about now to implement something like that. So that's kind of a non-starter for us, that we do have some impact. And by the way, for the investor that's listening that says, hey, look, well, why are you guys making that decision? It's out of my return. Well, it actually improves the quality of the property. It improves the referrals that we get online. It improves the stickiness of the tenants and the community that stay there. So it is really, in that case, and there's very many things that fit this description, but is a win-win. The structure, though, I think that we can really benefit families that are investing with us and that invested with us over many years, is that we try to mitigate as many risks as we can. In this particular deal, we've got here just a general structure. The number that I really want you to look at is that hold period, 2 to 5 years. I mean, there's a very big possibility that we could stabilize this project in 2 or 3 years and get 100% of that investor's money back, plus another $112,000. So I just want that to sink in for people, that typically when you see a multiple or it's over a 5-year hold, and we've certainly underwritten this particular model for a 5-year hold, but there is a good reasonable expectation that we could be selling this thing in year 2 and 3, and that we can get our investors money back to invest in the next thing.
Very cool. Okay, so I just want to repeat that because it sounds so crazy. Across the industry, what I see is a lot of people can double your money every 5 years if they do a good job. What we're talking about is actually getting people their principal back and an additional 112,000, which would be a 2.12 equity multiple. And if we're talking about between 2 and 5 years, that's a very fast return. Is this actually realistic? Can people actually create that? Is there something special about this particular model that allows for that value add multifamily cannot do?
Yeah, what I would say is we've had a little bit of a head start here, right? So we've got the land already in place, we've got the loan, we've already started building. So, people that are coming in now, it's a little bit different if they were investing, when we're in the kind of early stages of figuring out entitlements and such. So there are definitely some distinctions that I think built to rent, it has a superior kind of advantage to multifamily in that we can build each of these units singly and rent them up immediately so we consistently have cash flow coming in. I think it's worth noting that we've got very low operation budgets for these properties. So, if you're in a multifamily project, you should be in that 50% range. Well, this is brand new. This is new technology. These are brand new units, very low maintenance. So typically people are managing these properties in between 29 and 32%. So I think that there's things like that really make a difference. And if you think about somebody who has the opportunity to be in their backyard, with their dog and their doggy door, and there really is huge advantages as we go through some of the mitigants, the risk mitigants that we talked about. Really want to make sure that we have a real safety net for our investors. I think that will show through.
Speaking of safety net, what do you think would have to happen in order for our investors to lose money on this?
So this is the part that I think everybody, if you're kind of, in your kitchen, you're thinking about, well, Derek's kind of interesting to listen to, but I really want you to just stop for a second and just take a look at this slide that Ruben has, because what I just said in the previous slide was that if we execute our strategy, we can still believe pretty conservatively that we can deliver a 2.12 multiple. Okay, now that is partly because we've had some advantages and a little bit of a head start here. But I just got done saying that the average operating expense ratio for most projects in this built to rent space is at between 29 and 32%. So Derek says, hey, look, I just want to have a buffer just in case. So we underwrote that at 38%. Break evens at 62%. That means that we could pay our bills if we are only at 62% occupied. So 60 or so of those units that we've got of that 98, 61 and a half units only need to be occupied for us to deliver on this strategy. You've seen the contingency reserve. So we'd have to blow through the contingency reserve. We'd have to blow through that extra cushion we've got on our expenses. We'd have to come all the way down to 62% on occupancy. And then here's the big one. Cap rates, and let's just say it this way, values would have to decrease in that 2 to 3 year, 4 year time span significantly for us not to be able to deliver this deal. So if cap rates were to creep up from 5.25 where they are now to 6.25, this is still a better deal than that 18% IRR, 2.12 multiple. So I like to tell people, like, look, we're going to be somewhere in between. We're not going to win on all of these, right? We'll be somewhere in between the operating expenses. We'll be somewhere in between on the cap rate. But I already knew, because we had so much room, that we could underwrite at the low end and still deliver a real nice return to the investors. So that's why I want, you can go back to your dishes now, but I really want that to sink in, because there's an opportunity for you to change your family's life here in the next 48 hours. And usually these sell out pretty quickly, but that's the reason that I'm really trying to help shake people and, look at what we can do.
Yeah, it's a big deal, right? So I know about 100 operators, probably a lot more than that, honestly. Andy, same thing. He's worked in this industry for over 20 years, and we have both been very careful and diligent about selecting the very best operators that not only do good or are good at what they do, but that are actually having the greatest impact on the communities and creating the greatest returns for our investors, for our own families, right? So we're all in this, I think a lot of us are, for generational wealth, for creating the maximum return that we can in the shortest period of time and as fast as possible and with the greatest impact. So what I would like to do is invite you to get some additional questions. We didn't put everything in here and want to bore you with all of the details, but we have all of the PPMs, the operating memorandum. All of those documents are in our Syndication Pro portal. that you can find at legacyacquisitions.com. So we're going to include the instructions on how to access our documents, and then also include in the email how to contact Andy. Even though he's pretty easy to contact, we're not very hard to find any one of us. Our phone numbers are all on LinkedIn. So feel free to reach out to any one of us with any specific questions. And I also want to tee up here in about a few days, maybe a week, we're going to send out what we believe to be the most commonly and frequently asked questions as an additional video. So if you have some additional kind of curiosities and perhaps are wondering what people are thinking about this, we'll include some people's questions in that and then let you see that. So with that, we're going to sign off. It's been a lot of fun. Andy, Derek, really proud to be working with you. This is a very powerful opportunity that's not available to a lot of people, and the spots are probably going to fill up very quickly. There's just not a lot of space. It's a very small capital raise. It's only $2.5 million. We have maybe around 35 to 45% of that already soft committed. So if you want to participate in this, definitely reserve your spot, put in a soft commit. And with that, we're going to sign off. I congratulate you for focusing on your own generational wealth and being the hero of your own family and making the impact that you want to do, and letting us be the guide to help you get that fastest, most powerful income and return of investment. So with that, we're going to sign off. Thank you very much.